Welcome back to the deep dive. Okay, I am so energized today because we're giving you the inside track, the shortcut to understanding probably the single biggest secret threat hiding in high-yield retirement portfolios right now.
Yeah, we're diving deep. We've got the confidential details on covered call ETFs, the ones promising those massive yields.
Yeah, exactly. But they might quietly destroying your wealth. It sounds crazy, but the contradiction is real.
We've basically taken apart a 15-point internal analysis, piece by piece, and we're going to walk you through it sequentially. No holding back.
And you absolutely need to stick around for this. Here's the big tease. We are going to expose the, frankly, mind-blowing fact that some of these popular high-yield funds, they've underperformed the NASDAQ by 11% annually.
11%, it's huge.
And you wait, there's more. We'll show you the simple, kind of painful math, how you can lose $1,000 in actual capital while thinking, hey, I just made a 12% yield.
Yeah, the difference between the, let's call them winners, and the wealth destroyers in this space. It's unbelievable, so definitely stick around.
You won't believe it. And remember, you're with ChannelVest, you're expert in ETF strategies.
Right. So our mission today, take all this dense, data-heavy analysis and just pull out the most crucial, the most actionable insights for you. We want you to have a complete, clear understanding of the real risks and, importantly, the actual performance.
Okay, let's jump in. Where did our analysis start?
So the first thing we tackled, the heading was, No Decline ETFs, Your Retirement's Secret Threat.
Okay, setting the stage.
Exactly. This is where we lay out that core contradiction we mentioned. Can you really get high monthly income without, sacrificing your capital growth? That's the fundamental question.
And the big names are?
We're targeting the heavyweights, JEPQ, JEPI, QYLD, and XYLD. The big question we're asking throughout this analysis is, which one should you actually buy? Which one is maybe just a bit of a marketing mirage?
Right, because that choice, it makes all the difference between building real wealth or just, paying yourself with your own savings each month. High-stakes stuff for retirement.
Okay, now, before we get into the really dramatic numbers, we do have to cover the necessary fine print, the disclaimer section. It's labeled disclaimer.
Right, the important warnings. Got to do it.
We have to stress, this analysis, it's robust, sure, but it is purely for educational purposes. It is not personalized investment advice. Seriously, talk to a licensed financial advisor who knows your specific situation.
Definitely. And where did this analysis come from?
Our findings combine a lot of human expertise with AI-powered data mining, tons of web research, market data. It's comprehensive.
Okay.
But, and this is crucial.
Let me guess. Past performance.
You got it. Past performance is absolutely not indicative of future results. That golden rule always applies.
Always. But still, the past performance you're about to show us, it's a pretty stark reality check, isn't it?
Oh, absolutely.
Right.
Every investor, current or potential, really needs to see this.
Okay, let's get to the core issue then. The heading here is stark, the brutal truth. What Wall Street won't tell you.
Yeah, brutal is the right word. First off, the sheer size of this market now is just staggering. JEPI and JEPQ, they're the income champions, no doubt, managing a combined $72.1 billion. It's massive.
$72 billion. Wow. But there's a catch.
There's a huge catch. Let's talk about the dark side, QYLD. It's one of the older ones in the space, right? It has underperformed the NASDAQ 100 by, get this, 11%. Annually, since it started.
11% a year. That can't be right.
It is right. That's not a typo. Investors who bought into that whole high yields with no declines dream, they've actually lost 3.72% per year just in the share price. Why? Because of relentless NAV erosion, net asset value decay.
Okay, put that in perspective. That $8.45 billion sitting in QYLD.
Yeah, think about this. That money could have nearly doubled if it had just been in a simple, cheap NASDAQ index fund. That 11% annual lag, it's a catastrophic opportunity cost. Just wealth left on the table. But our analysis shows it's not all bad news. There's a massive split in strategy and results. We titled this part. But wait, the twist you won't believe.
Okay, twist, so it's about execution then.
Execution is everything here. We found very clear winners and, very clear losers. Let's start with the losers. QYLD and XYLD. Their capital just eroded, like a sandcastle at high tide.
How bad was QYLD?
QYLD delivered only, wait for it, 7.25% total return over 11 years. That's not income generation. That's just failure. XYLD, similarly, only 21.22% since May 2022. These are just too mechanical, too inflexible.
Wow. Okay, so who were the winners?
Now, contrast that with the winners. JEPI, which tracks the S&P 500, delivered a respectable 30.96% total return since May 2022, and with pretty low volatility, too.
That's decent.
But even better, JEPQ, that tracks the NASDAQ. It delivered a massive 66.25% total return in the same period. That's 15.77% annualized.
Huge difference. And why?
It boils down to active, flexible strategy versus that rigid, mechanical approach. Active management made the difference.
Okay, so there's winners and losers, but the whole sector seems Uncertain. You call the next section market reality check. The analyst war.
Yeah, war might be a strong word, but the disagreement is intense. What's really fascinating is within just 1 month, October 2025, 3 of Wall Street's biggest research departments issued completely contradictory guidance on this space.
Seriously, good.
Goldman Sachs and Morgan Stanley both came out and raised price targets for BlackRock, specifically citing the resilience of covered call ETFs and, the strong inflows they were seeing. They were bullish.
Okay.
But BofA Securities immediately came out and slashed their targets for the same area. They warned about fee pressures, long-term sustainability, basically raising big red flags.
So the biggest names on the street can't even agree.
Exactly. It just proves the deep uncertainty here. Even the analysts with all the data are fighting over the long-term picture. Nobody truly knows what the next 5 or 10 years hold for these products. And that internal debate, that analyst war, it leads us straight into the core problem we identified next. The heading says it all. Shocking facts. The covered call contradiction.
Okay, the contradiction again. Let's unpack it.
Yeah, our analysis really confirms what Prerna Matthews from McKinsey Investments said so perfectly. Her quote was, "There's definitely a trade-off. There's no free lunch." And she's absolutely right.
No free lunch, meaning?
Meaning that promise high yield. It comes directly from sacrificing your long-term return potential. These traditional covered call ETFs historically have just consistently failed to give you meaningful downside protection.
Which is often part of the sales pitch.
Right. And at the same time, they make you give up significant upside when the market recovers or rallies.
So you lose on the way down and miss out on the way up.
Well, you might lose less on the way down sometimes, but the key is you give up way too much on the way back up. ProShares research backs this up hard, confirms these strategies only recapture a fraction of the market's upside.
Got an example?
Perfect example.
Okay.
The 2024 bull market. JEPI, a good fund, right? It still lagged the S&P 500 by a full 14%. You were consciously paying a very high price in lost growth for that monthly check.
Okay, so if the long-term trade-off is so stark, why are these things attracting so much money? This section you labeled, the inflow insanity. Why investors keep buying.
It is kind of insane when you look at the performance trade-offs.
Yeah.
Despite clearly underperforming in bull markets, these funds are pulling in record amounts of cash. JEPQ alone took in $5.7 billion in the first 4 months of 2025.
$5.7 billion, that's huge. Where did it rank?
That landed it in the top 10 ETF inflows globally. It's incredible.
Why? What is the magnetic pole?
Honestly, it seems investors are just completely mesmerized by the idea of predictable monthly income. They see that yield number and they maybe ignore the total return picture.
Focusing on the distribution, not the overall growth or loss.
Exactly. And there's this thing called the volatility premium gold mine. Global X commentary talks about this, but basically when markets get choppy and volatile, the premiums on the options they sell explode.
So the yield can temporarily spike higher.
Precisely. It enhances the apparent risk-adjusted returns, at least temporarily, which just sucks in more investors who are chasing that yield number right now, maybe without looking at the bigger picture.
Okay, let's dive into the actual performance scorecard. Head-to-head numbers. We call this performance exposed, the champions versus the disasters.
Right. Let's see the data. You looked at the period since May 2022.
Yeah, that time frame gives us a good look at different market cycles, and the differences are sharp. Let's start with the 2022 bear market, the ultimate stress test, right?
Definitely. How did they hold up?
JEPI was the clear winner for protection. It was down only 3.49%. That's pretty solid defense in a rough market.
Okay, and the others? QYLD.
QYLD absolutely crushed. It sank 19.07%. It actually did worse than the S&P 500 index itself. Ouch. So much for downside protection there. What about the bull rally in 2023?
That's where the strategies really diverged based on their index. JEPQ, tracking the tech-heavy NASDAQ, just soared. It was up 36.28%. Really captured a good chunk of that rally.
And looking at the total picture through October 2025.
JEPQ is still the standout for total return since inception. It's holding a staggering 66.25% total return. That dwarfs JPI's 30.96%. Respectable for JPI, but JEPQ has been the growth engine.
So the underlying index, S&P 500 versus NASDAQ 100, makes a huge difference in the outcome, even with the options overlay.
Immense difference, absolutely.
Okay, everyone listening, pause right here, this next bit. This is probably the single most important concept you need to grasp about these high-yield ETFs.
Yeah.
You titled it the $100,000 reality check, NAV erosion in action.
Yes. Please pay close attention to this. Let's walk through the math step by step. It's simple but crucial. Imagine you invest $100,000 in an ETF that's promising, say, a 12% yield.
Okay, $100 K in, 12% yield promise. Sounds great.
Right. So 1 year later, you look at your account. You've received $12,000 in cash distributions over the year, probably monthly. Feels fantastic, right? You're getting that income.
12 grand. Yeah, that feels like winning.
But here's the hidden truth. While you were collecting that cash, the value of your underlying shares, the net asset value or NAV, quietly dropped. Let's say it declined to $87,000.
Wait, so the shares themselves lost value? How much?
In this example, $13,000, or a 13% drop in your principal investment. It eroded away.
Okay, so what's my total situation then?
Now you do the final check. You have the $87,000 left in the ETF shares, plus the $12,000 cash you received. Add them together.
$87,000 plus $12,000. That's $99,000.
Exactly. $99,000 total value. You actually lost $1,000 of your original $100,000, despite bragging about that 12% yield.
Wow. So the yield was real, but it was paid for by my own capital shrinking. You're just getting your own money back, minus a bit.
That is precisely the danger of NAV erosion. It's happening to millions of investors. They think they're earning income, but they're actually just spending down their principal.
Okay, that is a massive wake-up call. Call to action 1. If this reality check just hit you, seriously, hit that subscribe button right now. And tell us in the comments, have you seen this NAV erosion happen in your own portfolio? Share your experience.
Okay, so building on that, we need to look inside these funds. What are the actual risks in the holdings? We called this section Holdings Deep Dive, the concentration time bomb.
Concentration risk. Okay, what did you find comparing JEPQ and JPI?
Two completely different approaches. JEPQ, tracking the NASDAQ 100. We called it the tech casino. Why?
Okay.
It's highly concentrated.
How concentrated?
Get this, 46.24% of its assets are in just the top 10 holdings. And tech exposure, a massive 54.86%. Think about that. Over half the fund is riding on tech. NVIDIA alone is 8.15%.
So if tech takes a hit,
JEPQ feels maximum pain. And here's a key finding from our analysis. 7 out of its 10 top holdings were classified as having low resilience. That's a big risk flag.
Okay, so JEPQ is the high-risk, high-reward tech play. What about JPI?
JPI is the opposite. We called it the defensive fortress. It spreads risk much more like a professional poker player hedging bets. Only 15.71% in its top 10 stocks.
Wow, that's way less concentrated.
3 times less concentrated than JEPQ. And crucially, 7 out of its 10 top holdings were rated high resilience. So if your main goal is safety and lower volatility income,
The choice is pretty clear between those two on risk profile alone.
absolutely. Very different risk exposures.
All right, besides the main players, there are some, let's call them aggressive outliers, promising even higher yields, right?
Yeah.
Tell us about this section. The high-yield wildcards. SPYI and QQQI.
Yeah, these are the NEOS funds, SPYI and QQQI. And the yields they advertise are just mind-melting. SPYI at 12.16%, QQQI at 13.68%. Really eye-popping number.
How do they get yields that high? What's their strategy?
They use a slightly different option strategy, a unique two-strike approach. Basically, they sell their covered calls further out of the money compared to standard funds like QYLD.
And what did that do?
It leaves more room for the underlying stocks to potentially grow before the calls cap the gains. It gives them a bit more upside potential. And it seems to have worked, at least short term, for QQQI. It delivered 19.9% returns over 15 months. Compare that to QYLD, which was negative 4.54% over the same period.
Okay, 19.9% is impressive. But you sound hesitant. There has to be a catch. A huge catch.
There is. And it's fundamental. You absolutely must internalize this if you're looking at these funds. For SPYI, our analysis found 96% of its distributions, 96% were classified as return of capital, ROC.
Return of capital, ROC. Explain that again. What does that mean?
It means exactly what it sounds like. 96 cents out of every dollar you receive in distributions isn't profit or income the fund earned. It is literally just the fund giving you your own initial investment money back, disguised as income.
So they're just liquidating my investment and handing it back to me, calling it yield.
Precisely.
Yeah.
Now, there might be some short-term tax advantages to ROC for some people, but long-term, you are effectively spending down your nest egg piece by piece and calling it income. It's not earned profit, it's just drawing down your savings. Big difference.
Okay, shifting gears a bit. There's a new battle heating up, specifically for income from the NASDAQ 100. Our analysis looked at this rivalry in the section. Competition showdown. The new king emerges.
A showdown. Okay, who are the fighters?
It's the established champion, JEPQ from JP Morgan, versus a relatively new challenger, GPIQ from Goldman Sachs. Goldman launched GPIQ in October 2023, aiming directly at JPPQ's market.
A direct competitor from Goldman. How's it going?
Well, the early results are, frankly, pretty shocking. The buzz on the street, which our analysis confirms, is that Goldman Sachs might actually be beating JP Morgan at their own game here.
Really? Beating JEPQ. How?
Well, JEPQ is still much bigger, holding around $31 billion because it's been around longer. GPIQ. It culled in $1.5 billion in assets in just 2 years. That growth trajectory is incredibly fast. $1.5 billion in 2 years is an impressive ramp up, so the market's voting with its feet.
It seems like it. The chatter we picked up, summed up, was basically, sorry GPU, GPIQ is the new king of NASDAQ 100 income ETFs.
Right.
It's still early days, relatively speaking, but GPIQ is showing very strong performance right out of the gate. Looks like they learned from the earlier funds.
Interesting. A new contender to watch very closely then.
Mm.
So this whole discussion, winners, losers, new challengers, it really forces us back to the why. Why do some funds work better than others? This next heading seems key: active versus passive. Why strategy execution matters.
Yeah, this is absolutely crucial. It's the core philosophical difference in how these funds operate. Let's start with the passive strategies like QYLD.
The mechanical ones.
Exactly. They're purely mechanical. They use inflexible rules, sell calls at a predetermined strike price, usually at the money, write calls on a fixed percentage of the portfolio, month after month, no matter what.
And the problem with that is
they just cannot adapt. They can't adjust to changing market volatility, changing trends. Nothing. And that rigidity is what leads directly to that consistent, predictable underperformance and the NAV erosion we keep talking about.
Okay, so that's passive. What about active, like JEPI and JEPQ?
Active strategies are dynamic. The managers are actually managing. They adjust the strike prices, maybe selling calls further out of the money when volatility is low to capture more upside.
Makes sense. What else?
They also dynamically adjust how much of the portfolio they write calls on. Maybe less in a strong bull market, maybe more when volatility spikes. It's flexible.
So it's about judgment and adaptation.
Precisely. We found a quote from Michelle Tiraborelli that nails it. She confirms this active management provides the opportunity for better downside protection and, importantly, a much more thoughtful balance between generating income and sacrificing potential growth. It's not automatic, it requires skill, but that active management, that flexibility, it usually comes with higher fees, right?
Yeah.
Which brings us to our next analysis point. The expense ratio reality. Highway robbery exposed.
The fees. Okay, I should challenge this. Does the potentially better performance of active funds really justify paying so much more over the long term? Let's see the numbers.
It's a fair challenge, and the long-term cost is, well, it's sobering. We compared the estimated 30-year cost on a hypothetical $100,000 investment.
Okay, $100 K over 30 years. Give us the comparison.
A super low-cost S&P 500 index fund like VOO, expense ratio 0.03%. Over 30 years, the fees might cost you about 4,403%. Pretty negligible.
$4,000 over 30 years. Okay, now the covered call funds.
QYLD, with its 0.60% expense ratio, that balloons to $29,409 in fees over 30 years.
Whoa. $29,000. And what about one of those newer, higher yield ones like QQQI?
QQQI at 0.68%, even higher. You're looking at roughly $33,549 in fees over 3 decades.
$33,000 just in fees.
The difference is staggering. That $32,146 extra you pay in fees for QQQI compared to VOO. That is nearly an entire year's worth of that high yield you were chasing in the first place.
So the fees eat up a huge chunk of the supposed benefit.
And think about this. If a fund like SPYI underperforms a simple index like VOO by just, say, 1.07% per year, which our analysis suggests is quite possible because it caps the upside growth, then those high fees completely wipe out any tiny yield advantage the fund might scrape together. You pay that management fee regardless of performance.
That is highway robbery territory.
Yep.
Okay, call to action 2. You need to share this analysis. Share this deep dive immediately with anyone you know who's even thinking about high-yield ETFs. People need to see the fine print, the hidden cost, before they potentially lose decades of compounding growth.
All right, almost done. We've looked at strategy, holdings, fees. Now let's revisit the ultimate test, the bear market. Our final review section is titled, The 2022 Bear Market Test. Who actually survived?
Right, back to 2022. The NASDAQ dropped over 30%, a real-world crucible for these income strategies. How did QYLD fare in that?
QYLD, as we mentioned, got absolutely destroyed, down 19.07%. And worse, it took a brutal 14 months just to claw its way back to even.
14 months just to break even? That's a devastating loss of time, let alone the capital loss.
Yeah.
You missed any potential recovery during that time?
Exactly. A huge drag. Now, the verdict on protection during that period is crystal clear.
JPI, right?
JEPI absolutely crushed the competition on the downside, losing only 3.49%. That's impressive defense. And importantly, it recovered fully in just 6 months. Much faster.
6 months versus 14, big difference. But there's always a but, isn't there?
There is. And it's the core warning we have to reiterate. Even the best-in-class fund here, JEPI, the one that offered the best protection, it still couldn't deliver on that marketing promise of no declines. It still lost money.
So that whole idea of high yield with no declines.
It's officially busted. It's marketing fiction. It doesn't exist in reality, at least not in the way it's often presented. You might get less decline, but you don't get no decline.
Okay. We've gone through all 15 points of the analysis. It's time for the final verdict CT, the ultimate decision.
All right. Based on everything we've dissected, the inescapable conclusion is there is no such thing as high yields with no declines. That's the fiction. Now, let's talk reality and recommendations.
Lay it on us. What should people do? First, what should they avoid?
Avoid QYLD and XYLD. Our analysis clearly shows they are proven wealth destroyers. That persistent 11% annual underperformance for QYLD, the mechanical flaws, it's just not a winning strategy long-term. Target allocation for these, 0%.
0%. Got it. Now, what about the ones that actually performed well? JPQ and JPI?
These are the ones to consider, but carefully. We rate JPQ a strong buy if you're looking for a hybrid of growth potential plus income. It tracks the NASDAQ, remember. We're targeting maybe 13-18% annualized total returns here.
And allocation.
We'd suggest capping it. Target allocation maybe 10-20% of a portfolio max. Don't bet the farm on it.
Okay. And JBI.
JPI is also a strong buy why, but for a different type of investor. More conservative, really focused on income, less concerned about maximizing growth. It tracks the S&P 500, lower volatility. Target return maybe 9-13% annualized.
And allocation for JEPI.
Because it's more conservative, maybe a slightly higher allocation is okay, say 15-30% of the portfolio. Again, not the whole thing.
Right. So the big takeaway here is?
The actionable takeaway is crystal clear. If you are still accumulating wealth, building your nest egg, your absolute priority should be maximizing long-term compounding growth. Stick with low-cost, broad market index funds like VOO or VTI. Don't chase these yields yet.
But what if you're retired or nearing it and genuinely need cash flow now?
Okay, if you need the cash flow, then using JEPI or JEPQ for a portion that 20-30% combined range we talked about of your portfolio can make sense. But you must understand the trade-off.
And that trade-off is?
You are consciously giving up potentially 20%, 30%, even 40% of the upside gains you'd get from a pure index fund during bull markets in exchange for that more consistent monthly income stream. You have to go into that deal with your eyes wide open, know what you're sacrificing. And that leads us perfectly to the final provocative thought we want to leave you mulling over.
Okay, hit us with it.
Building on that no free lunch idea, the real fundamental question you need to ask yourself is this. Can you truly afford the massive decades-long opportunity cost? Can you afford sacrificing potentially decades of powerful compounding growth just so you can get a guaranteed deposit in your bank account this month?
Income versus growth. Present versus future.
Think really critically about what constitutes income versus what might just be a return of capital. Your own money coming back to you, maybe disguised as a reward. That distinction is everything.
That is the ultimate question. It really determines your entire financial future, doesn't it?
Okay.
Powerful stuff. Call to action 3. If this deep dive gave you value, please hit that subscribe button right now. Ring the notification bell so you don't miss our latest dividend ETF analysis, market breakdowns, and investment strategies. We deliver them straight to your feed.
Thanks for diving deep with us today.
Absolutely. See you next time.